Hello, everybody. My name is Bruce Montgomery, and this is my colleague, Tracy Preece.
Hello, everybody.
And we're with The Road to Retail. On our podcast, Tracy and I hope to offer tips, insights, ideas, and examples for how small, emerging, and challenger CPG, consumer packaged goods, brands can build their business. Everything from determining if you're ready to grow, where to start, how to prove it online, or how to go about securing distribution at a national retailer, driving your business through to the end consumer, or how to go about finding an investor if you're ready for that aspect. Bottom line is we would love to help you be successful by highlighting the many important aspects of this journey to establishing and growing your brand. Tracy and I have been doing this a long time. We've made a lot of mistakes, and we've done a few good things, so we're here to help you. Please follow our podcast on iTunes or Spotify, leave us a review, and consider sharing the show with a friend or colleague that may benefit from the content. Tracy?
Bruce and I have been involved in consumer packaged goods commercial operations roles for over 30 years. We define commercial operation functions relating to sales, marketing, trade marketing, broker and distributor management, agency selection and management, new product development, brand acquisition and divestitures, and customer management. We also invite on our episodes friends and former colleagues from all aspects of the Road to Retail process to come on the show and offer their opinions and experience. Again, we encourage you to subscribe to our iTunes or Spotify channel at Road, 2 Retail.
So Bruce, tell us about our newest sponsor.
Glad to, Tracy. Tired of getting crushed by chargebacks each time your brand sells product? From dealing with hundreds of forms that all look different to fighting tooth and nail to get repays, managing deductions is tough work. And you're almost certainly leaving money on the table. Fortunately, there's a solution. Floret was built to help brands like yours. With Floret's software platform, you can automate your deductions workflow, get insight into your trade spend, and even have your deductions disputed for you. Whether you're a scrappy young brand trying to break into retail or an established supplier looking to get sharper on trade, Floret will put money back in your pocket. We've saved brands hundreds of thousands of dollars this year alone. Visit www.tryfloret.com to book a demo and learn more. That's www.tryfloret.com.
Again, we encourage you to subscribe to our iTunes or Spotify channel at Road, 2 Retail.
Hello, everybody. Welcome to the most recent podcast episode of Road to Retail, where we interview our colleagues and friends within the CPG industry. So hello, Bruce. Good to see you again. And tell us a little bit about who we have today.
Tracy, welcome. Today we have a very special guest and a new friend of the show, Mr. Elliot Begoun, who is the founder of TIG Brands and the brand champion. So Elliot, welcome. Thank you for your time today. And why don't you just tell the folks a little bit about your background and how you got to this position and this very interesting firm that you and your colleagues have created.
Well, first of all, thank you guys for having me. I'm honored, glad to sit here and talk about retail and CPG. I'm a nerd, and this is one of my favorite topics to talk about. So to find some kindred spirits is always good. Started TIG Brands a little over a decade ago. I had spent prior to that 25 years, mostly corporate in CPG, slowly coming to the realization that I was a pariah, right? I was somebody who wanted things to be different, wanted to break things, wanted to reconstruct things. And when I finally worked up the courage to walk away from that corporate career and do something different, I felt really the best thing I could do was to bring that knowledge, those years of mistakes, the learning how to learn, to come alongside entrepreneurs and really move them forward. So we started TIG, and I started TIG really as a platform for emerging brands who wanted to build a business, something different than what we read about or see on Shark Tank, but actually a business that creates true enterprise value and optionality, and wanted to ensure that they had a place where they could come get educated, empowered, and equipped to do just that. And that was really the genesis of our platform.
That's awesome. I love that.
Looking into your background and website as we were preparing for the show, so far I would say that your jump into the entrepreneurial world has been very successful, and you've helped a ton of brands. Tracy.
Absolutely. So let's just jump right in. So Elliot, tell us a little bit about in more detail about what TIG Brands does, how they help small emerging brands grow, and then specifically talk about the collective and also about the Accelerator.
Sure. I mean, our primary goal is just to ensure that entrepreneurs find advisory support, that they get education, right? This is an industry, that is complex and nuanced, that they have access. Entrepreneurs, at the end of the day, so much of what they need is just swings at the plate, just opportunities. And then lastly, community. Being an entrepreneur is a pretty isolating journey at times. I mean, I always say that you've got two constant companions with you at all times, fear and doubt. And neither of them are exactly fun to hang out with at a bar. And so finding yourself in community of others who recognize that is key. The way we deliver that is in two programs. Our collective, which is really armed and aimed for early stage emerging brands. These are brands as early as pre-revenue, upwards of $5 million and so forth. And it's a one-to-many program, and it's delivered in two ways. First is, we have an online classroom that they can go on demand and take classes that run the gamut, from everything as sexy as how to do a 13-week rolling cash flow and build your pricing architecture, to understanding the anatomy of a venture fund and how to build a pitch deck, to how to hire and how to build culture. So all of that's there at their disposal to take. We also teach a weekly workshop that's interactive, that's virtual, but we get our founders very engaged. And then access, as I mentioned earlier, which is, ensuring that they have opportunities to be in front of buyers and investors and industry luminaries and people who can really help them. And then community, we do that through retreats. We have an online internal community behind our wall where they can learn things. And then probably the most important element is the advisors, the collective itself. So when they enter our program, they pay an annual membership fee, but they also sign an advisor agreement. But instead of an advisor agreement between themselves and one advisor, they're signing it between themselves and the collective, where there are over 50 advisors. And these advisors cover, all the basic, subject matter areas that you're going to encounter as an entrepreneur, from finance and fundraising to sales and marketing to operations, HR, well-being, all of those kinds of things. And those advisors are there to assist, to help, to unlock that wisdom. And that was really the genesis of that. It was a passion to try to find a better way to unlock the wisdom in our industry, because so many founders were collecting advisors like vanity plates. They were just something they put on a pitch deck, but not really working with these advisors to learn. The other purpose of the collective was to also change the complexion, literally and figuratively, of the boardrooms. I've been fortunate to be a board member, and still am, of many companies. But when I look around the boardrooms, they look like me. They're all middle-aged, straight white guys. And that is a problem, not just socially, but for an ever diversifying consumer base. If our strategy and thought processes are being governed by a very, homogenous, unaware a group of men, then we're unlikely going to be as responsive to the constituency that we serve. So we've been very, purposeful in trying to recruit, women and people of color and LGBTQ plus, and just, a more diverse set of potential future board members. And then in return, we provide master classes on governance and board management and fiduciary and M&A and all of that to help prepare them for potential future independent directors roles. So it's a cool program. Everyone shares in the portion of the advisor shares. So it's truly a collective. And then for those businesses that have matriculated past that, they're, somewhere in the neighborhood of 5 to 30 million, and they're, EBITDA positive or close. And they just, they're awkward teenagers. They don't know where to go next. They're trying to figure out how to build enterprise value. We come alongside and embed with them and work with them one-on-one to try to uncover what that next is, whether that's M&A, either on the sell side or buy side, whether it's a capital infusement, whether it's team or channel or category expansion, something that's going to move the business forward towards whatever goal they have set. Doesn't necessarily have to be an exit. It could be helping them create generational wealth or something in between.
That's awesome. I love that.
Very interesting. All right, Elliot, I got to ask, tell the folks about your mascot and critter behind you.
Yes, Tiggy, the tardigrade. It was a happy accident, to be truthful. I write a lot of content and was looking for the antithetical mascot to the unicorn, because I feel like we celebrate the unicorn, and that does most entrepreneurs a disservice. Because I don't know about you guys, but most of the entrepreneurs I meet didn't start what they started to have an exit or to do something that was purely a financial play. They did it to solve a real problem, to have an impact, something along those lines. And we put them on this pedestal of unicorns and set them on this road of making them have to accelerate and grow for the sake of growth. And it's why in this industry we have an 84.8% 2-year fail rate, right? And so the tardigrade became our antithetical mascot when I was sitting, Googling, using words like resilience and efficient and nimble, looking for creatures. And I found the tardigrade, the water bear, which can live in radioactive environments or at the bottom of the ocean, or they've been dropped on the moon. They're able to go into cryptobiosis, slowing their metabolic rate to 0.1% and live for 30 years without food and water. And the more I read about it, the more I realized that this was emblematic of what the kind of businesses and what I wanted to build. So I wrote the article, thought nothing more of it, and that was the end of it. Never felt like I would reference it again until I started getting tardigrade keychains and plush toys and car fresheners and all of those kinds of things. And not the sharpest tool in the shed, but quickly recognized this was something. And so we had an illustrator draw Tiggy up, and he's been our mascot now for going on 8 years. So
I love it.
That's a great story. It sounds like I think it was Jay Leno. It sounds like there's an ad to the old Jay Leno joke that after the nuclear holocaust, the only survivors would be Willie Nelson and Keith Richards. It sounds like Tiggy will be around as well.
Yeah, right there with them. Yeah,
they'll have a good band. I don't know if Tiggy can play drums though. So let's move forward here, Elliot. So when these companies come, and I realize based on what you said, maybe they've moved into the Accelerator and they're continuing to get traction. If they start wanting to raise money that may or may not be, let's say it's outside of the ecosystem you've built, what kind of preparedness or checklist do you tell these men and women? It's like, look, this is what's going to happen next. You're going to have to really open the kimono. You're going to have to go to a level of financial detail you maybe have never done before. People are going to say no. What counsel do you give them?
Well, first of all, is get used to rejection, right? And within every bit of that, there's going to be a nugget of wisdom, and the best entrepreneurs find that nugget and use it to get better iteratively. So that's number one. The second thing is before you ever start going out to raise money from investors, you have to be able to answer the question with surety and in an articulate manner. How am I going to make that investor money? Because that's ultimately, you have to put yourself in their shoes. That's what they're doing. And you have to understand, you have to be able to prosecute a case as to why you represent the best chance to make money. Where I differ from where a lot of people take the approach to fundraising in this environment is they tend to try to all fundraise in a one size fits all, convertible note, a safe equity round, and then they go out and try to negotiate valuation and do all of that stuff. And, that's fine. But, I think you also have to be realistic and recognize that the vast majority of the brands coming to market in retail, they're not rocket ships, they're Toyotas. They're not something that's going to launch and just explode and become something massive. They're just good, reliable vehicles or brands that are going to get you down the road. So why would you put rocket fuel in a Toyota, right? And you're only going to blow up, and that's what we see, and that's what happens. So the first thing I try to get entrepreneurs to think through is this concept of alignment funding. How do you align the outcome that you want for your business and what's best for your business with an outcome that's going to make an investor satisfied and happy, and really begin to work through what that answer is. And for many, it's not to get them to invest in what is basically a binary investment, which the only true path to monetization is a liquidity event, right? A sale, an exit. There are other ways to structure deals and other terms that you can develop that give a good return to an investor, but allow you to build the business in the way that's best for the business and for you. And so understanding that and becoming a student of this aspect of the business is critical. You are, as an entrepreneur, you are a professional. You are choosing to embark upon a profession, and like any professional, you got to take your shots at the free throw line. You've got to do the work. You've got to become proficient and good. And one of the areas you have to be proficient is, how am I going to capitalize this business, and understanding all the various options that you have to capitalize it, because it's much broader and bigger than what we talk about and share, in general, which is fairly narrow.
Great insight. I love it. Great insight. So, Elliot, let's talk a little bit about the process of raising money. So talk to our small emerging audience about, what does the process look like for raising money? What kind of information do they need to have? What kind of elements do they need to have to really attract an investor?
Sure. I think the very first thing you need to do is have a growth hypothesis. So a lot of people call these things financial models or strategic plans. And I don't like the use of those terms, because they're static, and that's not the approach you should have. Rather, you should have a growth hypothesis that is built from underlying assumptions about how and where you're going to find that growth. And so I recommend usually having a 5-year growth hypothesis that shows, revenue all the way down to profit and loss, and is steeped on the underlying assumptions, some pricing and the relationship between price and promotional spend and marketing and SG&A, and just really building building that from the account and channel level up so that you can, one, for yourself say, this is how I'm going to grow my business and this is what that looks like, versus just, I see so often somebody says, well, the total addressable market in this category is $1 billion and I'm going to go for 1% of it. That doesn't work. You have to really build that bottoms up. And then you have to be able to articulate how you're going to use this early money to validate these assumptions. Nobody expects that first 100, 200, 300, $500,000 to get you to scale. It's what you have to demonstrate is how you're going to use that money effectively to growth hack, to learn, to build, to prove product market fit. So have that growth hypothesis, number one. Next, be able to prosecute a case as to why you represent a good investment. So, and that doesn't mean that you can't call out the risks that are inherent in any risk-oriented business like this, but you need to talk about the ways you're looking to mitigate those risks and how you're going to take those risks out over time. And then you just need to be prepared. I mean, and by being prepared, yes, you need a good set of financials. You need a good, but also things that I've seen just, derail an investment opportunity is things that you haven't done, the basic work, like making sure you have your trademarks done and your basic regulatory compliance is done, and that you have an ability to absorb scale, when you start meeting with success. So you've got supply, good supply chain. You've got, existing agreements with co-manufacturers. All that non-sexy stuff needs to be buttoned up because, an investor, you're going to meet with, I talked to an investor friend, they saw 714 pitches last year, made one investment. So you're going to get no 99.9% of the time. It's a real bummer when you get one that says, I'm pretty interested, let's dig in, and you just don't have the basic stuff done. So growth hypothesis, good, financials, and simple, P&L, balance sheet, cash flow. All your regulatory and compliance, all of your ability to demonstrate supply chain stability, all of those kinds of things that make you a viable business and mitigate risk.
Makes
so
sense.
Elliot, one other follow-up here, please. So after all the counsel you just gave is super logical, and it's like the offensive line of business, right? Not very sexy, but when it's screwing up, then everyone knows that the offensive line is weak. What kind of reporting do these brands and founders need to be prepared to give? Because we run into brands and they're like, oh, I got $2 million, but now this person calls me all the time. I mean, yes, you've already said financial statements need to be well organized and reported on a, let's call it a quarterly basis. What other counsel would you give these people and say, look, these guys just gave you their money, they're gonna call you. How do you manage your investor?
Yeah, that's a great question. Well, the first thing I do is have that conversation, have that conversation. Hey, what should we expect from each other in this relationship, right? And by the way, as an entrepreneur, you should be doing your due diligence on an investor as well, right? And that means, call some of the other investments that they've made to say, hey, what's it like working with Bruce and Tracy? Give me feedback. And especially those where the investment has gone poorly. And there's nothing wrong with asking that investor that question too. Can you introduce me to a brand where it hasn't turned out well? Because it's all great when things are going well, but when things get tough, you want to know who you've partnered with. So that's one thing. So level set expectations from the get-go. Have that conversation. I think a best practice is at least a monthly executive summary that goes out to all investors. The format I always suggest in that is brags, bitches, and asks, right? So state your wins, laud some of the things that are your headwinds and struggles, and don't pretend like everything is perfect, and then always have an ask. Never have an investor communication where you're not asking them for something. And I don't mean a handout or more money, but it's an introduction, or is there someone that who could take a look at my most recent retail presentation, or does anyone have any insight onto this? These are really typically, especially if they're industry investors, well connected, well resourced. So I think that's important. But so often you don't have that upfront conversation, and then you get that investor who's invasive and they're calling you all the time. That's just because they're nervous and because you haven't set what to expect from each other. So I recommend you do that right up front. Hey, what are you looking for me? And if they say, hey, I want you to call me, once a week with an update, then you say, that's unrealistic. I can't do that, right? I need to run the business. So,
Right.
Yeah, that's great. And, I'm sure there's a more formal term, but Tracy and I refer to that when we have discussion like this, that you're looking for value added money. So what you're talking about with the introduction, or can you help me find a packaging person, or who knows someone at Target. So Elliot, knowing.
Just kind of interrupt there, because I think that's
Please.
I hear that all the time. People say, smart money or value added money. And in a perfect world, that's wonderful. But be realistic too, especially early stage investors. They are typically very well intended, but they're usually very, very busy people and got a lot going on. And so they're not going to be your panacea. They're not going to be somebody who's going to be able to deliver you to salvation. You can get help. You have to extract that help. You have to do it in a way that is reasonable for them and also simple for them. So if you want help with an introduction, send them a pre-written email and say, hey, can you just copy and paste this and send it to these 5 people? You've got to do the work for them.
That's a great idea.
Yeah, perfect.
So Elliot, let's dig in here a tiny bit more. And for the companies out there, and whether they're inside or outside your ecosystem, it might be easier if they were outside, for case of the example. If a company's doing between like 5 and 20 million, what are the kind of financing sources available to them? Because, some of our small emerging challenger brands, people that buy a brand that's dormant out of a big company and they need to wake it up, how do you do that? And if you could, explain any acronym you might use, because people hear, they're like VC, angel, friends and family, So what do you see? Like, what's kind of that hierarchy where you're not giving away everything you've built for to be independent, but then you give 60% away for $500,000 and suddenly you're an employee again?
Well, there's a lot. There's so much. I'm going to put it into 3 buckets. Okay. I'm going to put it into equity. I'm going to put it into debt, and then the hybrid that I'll call dequity, which is a growing way to fund business. So equity is, when you are selling ownership in your business to an investor, right? And the most typical form of that is just, selling stocks or selling the future ability to convert to stock, like a convertible note, which, is where you make an investment and it starts as a promissory note, but it converts at a certain trigger, like the raising of a larger round of money or a price round or something along those lines, or a safe, which is its close cousin, right? It works a simple agreement for future equity. And those are the most common ways that money's been raised in this space, but I would argue not often the best way, because if you look at equity, really as a private placement equity, the only real opportunity to monetize that investment as an investor is if somebody buys the business, right? Because there's not an open, it's not like you can, trade on the floor of the New York Stock Exchange. You basically need the business to sell, or in some cases you might find another interested buyer, but that's, for your shares only. But for the most part, you're banking on the eventual sale of a business. And especially if you invest in a convertible note, because then you need two things to happen. You need that initial growth of the business to be fast enough to attract that bigger investor who's going to convert, that's going to cause that trigger to convert that note into shares and then exit. And that's very hard, and it's unlikely. The most common occurrence in that type of investment in CPG, the statistical mode is a zero. So understanding that, then let's look at debt. It's interesting that for whatever reason, we carry a lot more angst around debt than we do around equity. But debt's non-dilutive. You're not giving ownership of your business up. And it used to be that, community banks and people like that, that's how businesses started. You went down to your local community bank and you got a loan and you started a business and you paid it back. Those days are, for the most part, are gone, and most banks aren't loaning to businesses and industry, in the very early days. But there are a lot of non-banking lenders out there that are doing things based on your assets, such as receivables and inventory. There's merchant cash advances. Some are truthfully predatory. Some are wonderful, but that can be a really good way to fund a business if your contribution margin being what's left after everybody's hands are in your cookie jar, right? So
right.
to cost of goods, to all of the other transactional expenses, whatever's left, that's your contribution margin that goes to absorb your fixed costs. And if that contribution margin is positive, you can afford potentially to take on some debt. What's growing in interest and intrigues me a lot is this hybridized equity, where you have an opportunity for an investor to find what's called a structured exit, a way that they're going to have an exit without needing the sale of the business to happen, but still give them a path to ownership or a path to participation in long-term upside. And we've been really active in that space. We've actually authored a few instruments ourselves that we've worked with attorneys on and invested in, and have then open sourced them and made it available, similar to what Paul Graham did with the SAFE. We just wanted people to do it. And in those kinds of instruments, what you're doing is you may bring in an investment and pay a percentage of net revenue or cost of goods or EBITDA back to that investor on a quarterly basis until that investor hits a multiple, let's say 1.5 times their invested amount. But they also have a path to participate in future upside, either through a warrant, which gives them the right, kind of like making a dinner reservation or locking in a mortgage rate, the right to buy shares in the company at a future date, or you do things through redeemable equity, where you sell the equity now, but you redeem it, through payment. So you bring that equity back and take it in. And so those hybridized models are becoming better and more impactful for both investors and founders alike, because they eliminate that zero sum, kind of binary, investment option, which is, I need this business to grow. Because in that zero sum environment, what you realize is there's something called the power law, which basically says that in investments of those type, that one or two investments are going to outperform all others by an order of magnitude. So in other words, you need one or two of your investments to be huge, because the majority of them suck and are going to be
right.
And so that just puts a lot of pressure on a business to be that one, and if you're not, then you're the zero. So lots of ways to learn, lots of, and this is overwhelming to most entrepreneurs, and there's no shortcut other than to bring people around you who understand this and let them guide you and teach you, and be curious and ask the questions and learn and study and talk to other entrepreneurs and see what they're doing. because, you can have a wonderful product, a great marketing strategy, a great go-to-market strategy, but if you don't have a good capital strategy, the rest of it doesn't matter.
So, Elliot, what kind of firms put together this Dequity instrument?
It's a growing number of firms, so it's not your typical venture firm, because
Okay.
venture sets up is, they are structured for the moonshot. That's what they do. That's how they're built. So it's a lot of them are family offices, impact funds, as well. Some of them are now just some new standalone funds that are building up. The biggest one is actually a fund in tech, and it's called Novel Capital. And they've actually they do a podcast themselves now talking about this, and they're doing that in tech, based on revenue and percentage of revenue being paid back. So it's starting to blossom, but a lot of times what you're going to have to do, especially when you're in early stage, it isn't funds, it's individuals, but you can bring individuals different solutions. So, to that earlier point where I said 714 pitches, of that 714, if 713 of them show up with a convertible note, and you show up with this different offering in a way to, take risk off the table every month, to give them a path to exit.
Yeah.
You're already differentiating yourself compared to all the others that are vying for the same money.
So you might think this is impossible, but I want to torture you with one more sub question here on this topic. So the very small brands that contact either your firm or that call in and write to Tracy and me that might be doing a little under 2 million in revenues and they're looking for cash. What are their options if they can't bootstrap it themselves or friends and family? Is there anything to do except, become Tiggy and just freaking sweat it out, man, and make it work?
Well, I mean, that is an option that, is an important one, and you still should be looking to do that. But yeah, there are options. So, depending on the category you're in and depending on your unit economics, the first thing you have to do is make sure that you're not just building a brand, that you're building a fundamental business, with good unit economics and something that makes it viable as growth. Doesn't have to be optimized, yet, but needs to have that. And if you do that, then yes, I mean, there are angel groups and angel syndicates. In CPG, we are the angels. wearetheangels.com is one of the largest angel groups out there, and they invest pretty early. But also it's going after all the usual characters, local angel groups, local angels, but again, thinking through, like, I mentioned on our website, you'll find an instrument we call the CARE, the COGS Agreement Retaining Equity. That's a very simple way as an early stage business to raise some money. If you took that and you have good unit economics and you want to go out and raise $250,000, you might take that to somebody and say, listen, I need $250,000. Here's the agreement. I'll pay you, 2 times back over the next 5 or 6 years based on my forecast. And I'll pay you a percentage of my cost of goods every quarter. So once a quarter, you write them a check. And the benefit of that kind of structure for you is that it grows as your business grows. It ebbs and flows. That delta between what you're paying and where your business is always remains the same. Whereas if you just went out and tried to get a loan, and the loan is amortized over 48 months, you're paying that 1/48th every month, whether your sales are $100,000 or $1 million, and often, that's too steep a climb for you. But structuring something like that, where you're paying only that percentage of cost of goods or revenue, works for you. You can make that payment. You could take that out of the business and plan for it. And for the investor who's going in early, they get money every time you send a check. They take the risk off the table. They get to know you. They get to see you mitigate, take all the white hot risks out of the business. And in their drawer, they have that warrant, that reservation to be able to come back in and write you a bigger check and do it. So I suggest, all businesses consider that and take that to angels, angel groups, and so forth.
And that's interesting because as you're writing them those checks, no pun intended, but every time you write that check, you're building your own personal equity with those investors that you're good for your word and that your business is real.
That's right. That's right.
Absolutely.
And also keeps you focused on the fundamentals of building a business, not just a brand.
Right. So let's talk about that a little bit. I know you see a lot of brands come across your desk. So tell our audience today what TIG Brands looks for but when you're looking to invest in a brand or a company. Is it the brand? Is it the founder? What are your triggers that says, hey, this looks like something we would be interested in investing in?
Number one is it's people. I mean, it's always been, 35 years I've been in this industry. It's the number one thing is people, and you want people who, obviously are passionate, because passion is going to give you the necessary resolve, that's needed at the base of this. And it needs to be also, you need to be blended between being fierce and malleable, right? You need to be able to stand up for what you believe and be able to advocate for your brand, for your business, for yourself. But at the same time, you need to be able to be shaped and molded and coached and so forth. So person number one. Category product is important, but really for us, it's also around business, and I keep coming back to that. I believe that CPG is going through its .com moment right now. I wrote an article about this a month or so ago. If you look back to what's happened in our industry, you can draw a direct line to what happened in .com. In 99, 2000, we heard about the .com bust. Why? What happened? Well, there was a downturn in the economy, a recognition suddenly by the capital providers that they were capitalizing and investing in businesses that weren't, in brands that weren't businesses. The things that they were focused on are acquisition of customers and traction and all those things, but there were no underlying economic models to it being business. And so then a lot of that funding moved into CPG, and guess what? They started doing the same thing. They started investing in business, in brands that were, growing ACV, growing distributions, showing velocity and so forth, and not looking to see underlying, is their unit economics work? Is there a path to profitability? Are they, is there real margin in this product? Because the thought was, we'll just build this great traction, great brand, then a big strategic will buy it. And what has come to pass is that in most cases, when a large CPG multinational strategic buys a wildly unprofitable, emerging brand, puts it into their system with all their economies of scale and all their talent, what they wind up with is a wildly unprofitable brand. And they started investing, walking away from it and doing all of that. And now the money's rolled up, right? And now it's very hard if you're sub 10 million, really sub 20 million, to get the big venture dollars to come in. And so now, so more than ever, you have to have a viable path to profitability. You have to be a business first, which I think in the long run is really, really healthy for our industry, because I think our industry, our consumers are tribal. They want, you've got your plant-based eaters, your keto, your paleo eaters, you've got your climate activists, you've got, all of those things we're creating a lot of niche brands, functional brands, things like that are, businesses that could be 20, 30, 40, $50 million businesses, but if they're built right, can be businesses that are throwing off, 15 to 20% EBITDA in the long run. and you can make a lot of money. The owners can make a lot of money, the founders and the early investors. So when we're looking, that's what we're looking for. We're looking for tardigrades. We're looking for brands that are going to have a path to build into being nimble and flexible, being capital efficient, and being resilient, so that when things get tough and they get the gut punches, it reminds me, of I tried to explain this to our grandkids and they had no conception of it, but there used to be those Bobo dolls, an inflatable clown with sand at the bottom, and you could punch it and push it down and it would, go down and come right back up.
Back up. Yeah.
That's kind of what we're looking for is entrepreneurs and businesses that have that Bobo doll like resilience, because that's what it takes.
Hey, Bruce, what does Mike Tyson say?
Everyone has a plan until they get punched in the face.
Right. That's right.
So, Tracy, we're going to do an audible because Elliot's already covered this next topic about what we look for in an investor. We've really covered that one well. So, Elliot, you may have touched this as well, so we could scoot through it quickly if you feel so. But what mistakes would you tell brand founders when they're approaching initial investors? What's the mistake not to make? I mean, you've given really great counsel about how to be prepared. Is it sort of like bad high school dating? Don't bring my mother flowers on the first date. Don't press things too hard, or is it you want the people that say right what they want right away, so you're not wasting time?
Well, I mean, I would say three things in particular come to mind. The first is that you forget what you're there to try to portray. It isn't about you or your brand or anything along that. It's how you're uniquely prepared to make them money. And that sounds greedy, but it's not. I mean, that's the business, and that's the business of investment, is to put money in to make more money out. So if you aren't talking about how you're going to make them money, how you're going to bring them a return, then you're missing the opportunity. So that's one. Two is that so often when you're in an investor meeting, you're trying to get that yes, right then and there, and that's never going to happen. The goal of an investor meeting isn't to get a yes, not the first meetings. It's just to get to a next meeting. And so you want to make sure that you get them interested, but yet leave them with some questions so that they want to investigate and explore things further, and give a path for that. Like, oh, that's a really good question. You know what? Can we schedule a call in 2 weeks? I'll go back and do a little research and come back and give you a good answer. Set that up. The goal of an investor call is just to get the next call.
Keep the door open.
Yeah. Just keep
the dialogue going.
Yeah. And then the third one is closely related to that. We waste a lot of time in ambiguity, right? And you need to get to yes or no, and not stay in that friend zone, the unknown. And so often what we do is we don't follow up well, right? We don't follow up aggressively, and we give up too early, and you need to do it, until basically you either get a yes, a no, or a restraining order, one of the three. And
I love that. That's classic.
But it's true, and
it's absolutely true.
What we do is we sit there, we have a good meeting with the investor, we send an email, and then we sit there going, oh my God, they're ghosting me. What are we doing? What do I do? I don't want to send another email too soon. It's going to seem like I'm pushy, and then you wait a week or two and you send another email, but that's like starting the whole process over. Google's done that research, and they say, it takes basically 7 touches and 11 days to get meaningful transactions. So use that. What I recommend is simple emails, within a 24 to 48 hour cadence after an investor meeting, not like, long or, deep explanations of points, just like, hey, Tracy, thanks again for that meeting. Just keeping this top of mind. If they don't respond 24, 40 hours later, hey, Tracy, just bumping this back to the top of your inbox,
Right.
just be diligent in that, because it builds up enough, at least, cognitive dissonance in somebody that they're going to have to respond. And even if that response is, hey, you can stop emailing me, this is an investment I'm going to make, that's huge progress, because that's checked off the list and you're not
Yeah,
waiting.
you get to know as fast as you can, right? So you
Yep.
can move on to the next one.
Yep. Those are three common mistakes that I see.
Right. So we're going to call another audible. Tell us a little bit about your greatest success in your career. What are you most proud of?
That's a really, really tough question. It's kind of like asking, which one of your kids is most successful. I will pull it back a little bit, and I will say, the things that I and this is going to sound woo woo, and it's not meant that way, but I'm almost 60, and I look at things now as impact over income, and so that's what matters to me. Are we making an impact? And what I feel best about is that there are a lot of entrepreneurs who have gone on to have successful runs in their business and have made really important contributions to the industry or to the climate or to society or to whatever they were going after, because of the help we gave them. And that means a ton. But probably the biggest success is that I'm still such a student. I wake up every day and I'm learning every single day, and I think that is great. And we've had some great rides. I mean, I think of the Good Chris company. I'm the chair of the board of that company, and I started working with that business in our early program when they were pre-revenue, and now they're pretty.
Now look at them. I love it.
So,
Love it.
So.
Okay, Elliot, let's turn that for the old school. Let's turn the record over. What's something you might wish you could do a do-over on that you've learned along the way here?
The great question, and the honest answer is nothing. I get at, one of the questions I ask myself, and I get asked often, is, do you wish you left your corporate career earlier? Because I never found myself. I had a lot of success there. I was very lucky, and climbed the ladder like I was supposed to, but was never happy. Should I have left earlier? And the truth of the matter is that, as much as I would have loved to, I wouldn't have been ready, right? I wouldn't have had the knowledge base that I needed. That was my postgraduate fellowship, those years.
Right.
I don't regret things. I just learned from them. I think that I guess my only real regret is I spent so much of my career and life trying to not feel vulnerable, and now have learned that when you are vulnerable is when the greatest growth and the greatest opportunities happen. When you can
so true.
Completely uncomfortable, it's when you're doing something right. And I wasted a lot of time trying to wall that off and protect myself from that, because that's what you're kind of taught in you're institutionalized in the corporate world, is to not be exposed, to not be vulnerable, to not. And that is just bad thinking. I'm completely okay with failing and feeling exposed and worried. Doesn't mean that I'm not worried, and doesn't mean that I don't get scared or stressed or any of that, but I know I'm learning in the process.
Well, I think what you said there is really interesting, that in your prior answer, when you said you continue to learn, when we all run across people, no matter who they are, who think they know everything, that's the person I want to compete against.
Yeah.
Because they're standing still, man.
Absolutely.
I say
Cool.
I say this all the time because I feel strongly about this, and that is I I tell all our entrepreneurs, listen, if you're looking for me to have the answers, sorry, I'm going to disappoint you. But what I do feel I bring is I have the questions. That's the mindset, right? And
Mhm.
if you have enough wisdom and experience, you can ask the questions that others haven't thought of because you have the wisdom and experience, but you still don't have the answers. You just
Mhm.
have a different set of questions, a deeper set of questions.
Why such wisdom there? So, Elliot, as we wrap up, tell our audience how they can reach you if they want to reach out.
Yeah, you can hit me on any of the typical social platforms, LinkedIn, and but easiest is just either go to our website, which is www.tigbrands.com, or feel free to email me directly, Elliot, 2L's 1T at tigbrands.com. Always happy to have a conversation.
That's
All right.
awesome.
Well, Elliot, this has been absolutely fantastic. Thank you for your time. Super interesting discussion this afternoon. Tracy, bring us home, man. Big finish.
Absolutely, Elliot. Again, thank you so much. A lot of wisdom here. I know our audience is going to really love listening to this when we air it. And we just want to say thank you to our audience for joining us today. And please continue to follow us on our iTunes and Spotify channel, Road, the number 2 Retail, or also on our LinkedIn page. So thank you again for joining us today.
Good luck out there.